Welcome, Jay.
Thank you, Todd.
Yeah, I appreciate you coming up here to Sacred Heart University to meet with me today. Today is our first BitX Capital podcast, and I'm so excited that you're here today to have a conversation with me. And today we're going to discuss the mortgage business and, what is going on in the home mortgage business, what's going on with interest rates, what's going on with the economy. I want to introduce you by saying I've known you for over 10 years. We've been working in the Sphere group for many years. I remember, meeting you the first time in Westport and over the years, just admiring how hard you work and the fact you get up every day and make all those phone calls, meet with all those real estate agents, meet with all the different business people in the community. And year over year, you crush it. You're far ahead of any broker that I know.
Well, thank you, and I'm super honored to be on the first podcast of many, I would assume, for BitX funding. So, really appreciate being here, and it's great to see how your business has grown over the last 10 years since I initially met you. So, congratulations.
Thank you. And so, how is Carrie and the boys?
Carrie and the boys are great. Yeah, no, everything is good. I've lured Carrie into the mortgage business over the last few years too. So, besides hearing it for 20 some odd years, she's now in it doing some marketing with us. So everyone's doing great. Thank you for asking.
And so you have the office in Fairfield on Miller Street. And again, it's CrossCountry Mortgage. And so tell me a little bit about the office and your team.
Yeah. So like I said, I've been originating loans for 20 some odd years. And for the past 6 years, I've been affiliated with CrossCountry out of Cleveland, Ohio, a small company back in the day that started, I think, early 2000s. And I joined here about 6 years ago, and the trajectory of the company and the winning spirit of this company is what's driving our force here in the marketplace. So we are what's considered an independent mortgage banker. So if you think about getting a mortgage, you can go to your traditional bank. You can go to an independent mortgage banker, which much like BitX, we shop our loans around with multiple lenders, or you can go to a broker. So we're in that independent mortgage banker space. And we are currently leading the charge as the number one producing origination company in the country right now. So very excited to be here. Great company, great support. And really, I guess the analogy that I give to consumers all the time when you compare an independent mortgage banker to a bank, and I think it's a simple one. When you go to a bank, you have 4 flavors of vanilla, right? When you come to CrossCountry, an independent mortgage banker, you have the whole rainbow of colors, right? The whole rainbow of flavors.
Right.
We can get you the traditional mortgage. We can get you a construction loan, renovation loan. We can get you a reverse mortgage, or we can do the niche loans for self-employed business owners, which is basically the space that you play in on the business side.
That's right.
So it's been a fantastic company. I appreciate the compliments and accolades, but I really can't do it without a fantastic team, which I've been building over the years.
Okay, great. All right. So if I'm a first-time home buyer, or let's say I want to refinance my house, what are some of the key considerations I want to look at when it comes to mortgages?
Well, first let's talk about the current state of the market, right? And right now, the current state of the market means that 90% of the loan production that's out there is what? Purchase money mortgage, right? Because when people were refinancing 2 years ago, they were getting a 2.5 or 3.5% interest rate. So the only people that are really refinancing right now are people who need some debt consolidation to free up some cash flow, right? Or someone who goes through a divorce and needs to get another spouse off of the loan. There's there's very few reasons why people are refinancing right now. So refinancing is a specific need currently at the moment versus in 2020 and 2021, it was like, hey, Todd, drop your rate from 6 to 3, let's go, right? So it's a little bit different on the refinance side. On the purchase side, the biggest struggle and challenge for consumers out there right now is in 2020, they saw rates at 3%. And today they might be seeing rates at 7.5%. So mindset is a key driver in the market today.
Yeah, I love that mindset because I'm seeing it right now in our business where people are so used to just cheap money. And now when you tell them, listen, unsecured money, it's in the teens. And they're like, what? And so I have to help them reframe it and say, it's more about getting access to the money And then from 5 years from now, where will your business be if you put that money to work? And so tell me a little bit about how you help the home buyer,
Well,
with that struggle.
so on your side, business wise, it's like opportunity cost, right? That's probably a lot of what you're talking about with your folks.
Right.
And the same thing on the home buying side, it's basically the same thing, right? Do you want to take the opportunity to buy that perfect home right now, even though the rate is at 7.5%, knowing that in a year, 2 years, 3 years, when rates come back down, you can refinance that rate, right? If you take out an interest rate today,
Mhm.
or if you take out a loan today with an interest rate, you can refinance it. So you're not stuck with that rate, right? So, when I talk with people, the one thing that is very important for people to realize is if you can afford that home, Todd, and it is the right home for you and it makes the right sense, it is a good time to buy because you can always modify that rate later by doing a refinance, correct?
Right.
The hard thing for them to swallow is, oh my gosh, at 3% I would have been here, and now you're telling me at 7.5 or 8% I'm here, right?
That's
So
right.
a lot of it is the mindset of the person who's buying. Okay, um, the challenge for people is that payment, right? The biggest driver, Todd, of people's thoughts about buying is interest rate over home value.
You're right. Okay.
So the interest rate drives their emotions more than the fact that home values have gone up.
Right. So, but back to payment, if somebody's like, "Oh, I really have to have this house," but they can't afford the payment, should they be doing that?
No, I mean, listen,
Or should they go out and look for the appropriate home?
yeah, they have to reframe their expectations in
Right.
certain cases, right? So as rates have gone up, you've definitely had some buyers fall out of the market, right? And that's normal to happen when affordability becomes a challenge. That being said, rental rates have gone up as well,
Mhm.
right? So they either have to buy the house, rent, or live with family. So they've got to put a roof over their head in some way, shape, or form. But we are not getting people into homes that they can't afford because they have to qualify.
Right.
So really, I think what it comes down to is, hey, Todd, you can qualify for this home. You don't like the payment,
Right.
but you will be able to modify that payment at some point. We don't know when, right? So a lot of it comes down to that kind of a conversation. A big question that we get right now is, should I wait for rates to come down?
I would think yes.
Right? That's a common thought.
Right. Whoa. Let's just hang around until rates come down. But what will happen if that happens? If I wait too long?
Well, first let's roll back to 1971.
Okay.
Okay. In 1971, if you said, I'm going to wait for rates to come down to buy a home, do you know how long you would be waiting? Take a guess.
Um, oh, 5 years
20, it's either 21 or 23 years. I think it's 21 years. In 1971, you had to wait 21 years.
for rates to come down.
Yeah.
Well, yeah. So you would have been boxed out of the market because inflation.
Over 2 decades,
Right.
right?
Yeah.
Whether it's 21 or 23, it's over 2 decades you would have had to wait.
Right.
So do you want to wait? I mean, we don't know when rates are going to come down. The one thing that we do know is that when rates do come down, so every 1% that a mortgage rate comes down,
Mhm.
it's estimated that 3 to 5 million people enter or re-enter the market. So there's people that were boxed out or new people. So think about that. If rates go from 7.5 today to 6.5, let's just say,
Right.
you have 3 to 5 million additional buyers that come back into the market.
And limited inventory.
Limited inventory today.
And so prices are just going to rise even more.
Throw 3 to 5 million additional buyers on, what happens? It just becomes a bigger crunch.
So just be in today and make your business decision for today.
I think personally, you just have to be in the game.
Yeah.
And then you have to execute the play at the right time, right? So when is the right time? In my personal opinion, you don't buy a house just to buy a house. You buy a house because it makes financial sense. You buy a house because of need. So if you find that house down the street, it's beautiful, it checks all the boxes, and you can afford it, yes, the rate's 7.5, but you should probably buy it. Now, if you're buying a house today and you know you're going to be relocated in a year, it's probably not a good idea to buy, or it's a very strong consideration to not buy, right?
Right.
But if you buy a house and you're planning on being it for some period of time, buy the house.
Yeah. Most people, stay there for 20 years.
I mean, listen, we live in Fairfield.
Mhm.
The estimated rate of appreciation over the next 5 years on average in Fairfield is just under 5%.
Wow.
So you buy a home today for $500,000, you're going to get about $25,000 over the next year in appreciation.
Yeah. Nice.
So do you want to lose that?
No. I think it's smart to not sit on the sidelines, not worry about interest rates, but make a decision based upon where you want to live and the community, the school, and checking all those boxes. And if you can check all the boxes and you can afford the payment, it should be a go.
Yeah.
Great. All right. So let's talk about the Fed. Let's talk about rate impact. I'm seeing on the business side, back to, we've kind of mentioned it earlier, that people see interest rates, at 5%, and now they see interest rates at 15%, and they just get scared and they just don't bother. But at a certain point, they're going to dry up in liquidity, and they're going to need money, and they're going to finally come around to realizing that interest rates are here to stay for a while, and they need to make reframe it and make decisions. So, what are you seeing on the overall rate impact, and on the market?
So, listen, we are pre-approving. We are talking to, let's start with lead inflow. We're talking to about 75 to 100 new potential clients per month, 75 to 100 potential new clients a month. And of that 75 to 100 clients, we are pre-approving roughly 30 clients a month. So over a 10-month period, we're pre-approving 300 folks in that time period. Okay. So the flow is still coming. Okay. We're getting them ready and telling them to be in the game, right? Would you rather buy that home at 7.5 and find that right home, or totally sit on the sidelines and not buy that home, right? So let's just talk about a scenario that we worked through the other day. $650,000 purchase, 20% down. At current interest rates with estimated property taxes and homeowners insurance, their payment was going to be right around $5,000 a month. Or they could go rent the equivalent home for about $5,000 a month. So if you rent a home for $5,000 a month, over the year, you're paying what? $60,000. Right? Now, if you bought the house, you got a pay down of principal, I think it was around $4,500 for 12 months. They bought down the mortgage by way of paying principal about $4,500. And they got about a 5% increase in their home value. Okay. So they picked up about $30,000 in home value increase. They paid down the mortgage by about $4,000 to $5,000. Right. Now, if they had rented, they would have lost or spent $60,000 that they're not getting back.
Okay. All right. So I am seeing a lot of impact in credit these days. I'm seeing people that have 800 FICO scores, 700 FICO scores, 600. And I'm starting to see a lot of people start falling into the 500 FICO scores. And so that means a lot in the business lending space, because it kind of goes back to what you were saying, is the higher the risk, the higher the interest rate, and the lower the term. And the bigger the down payment would be, let's say on an asset-based loan, such as a big piece of equipment. So how key is credit in your world? And can you speak to credit for first-time home buyers? What do they need to do to monitor it? I remember listening to you in one of our meetings, and you talked in depth about credit. And so I was wondering if you can elaborate.
Yeah. So, I mean, listen, when you think about underwriting a home loan, you think about four things. Okay. You think about their credit, you think about their income, you think about their assets, and then the fourth piece is the collateral, also known as the house, right? So those are the four things that we're looking at when we're underwriting a loan. And the number one thing is credit. So credit is the number one important piece of the puzzle, in my personal opinion. And the higher the credit score, the more options you're going to have. Okay. We are seeing credit scores, come down a little bit over time. But that shouldn't scare someone away from coming to meet with us. First and foremost, when we pull your credit and we look at your application, we do a soft credit pull. So everyone's worried about their scores being affected by a hard inquiry. Number one, we're doing a soft credit pull every single time.
And that's huge.
So that's not going to hurt them. Okay. And then we will give them advice based upon the credit. Now, we're not a credit repair agency. We're not credit counseling, but we can look at credit. And, Todd, let's say you have a $10,000 credit line on a Citibank credit card and you're maxed out being maxed out on that credit card is hurting your credit score. So if you pay down that card, Todd, or you pay that card off, you could very well get a nice bump in your credit. Now, people who have credit that is very challenged, where they can't buy a home right now, they have options where they can go seek credit counseling or credit repair. And there are some very good companies out there that do that. I would tell everybody, don't sit on the sidelines because you think your credit isn't great. We've had people come to us, Todd, and say, oh my gosh, I'm not going to apply, or I'm nervous as can be about applying because I'm afraid. Don't be afraid. Let us pull your credit. It's a soft credit pull, right?
Mhm.
Now, if you're out there in the marketplace and you want to take a look at your credit without any impact and without paying any money, you can go to annualcreditreport.com. You can pull your credit for free. I think right now, because we're still in the COVID time period,
Right.
I think you can pull it actually like every single week. You don't need to,
Right.
but you pull your credit twice a year. It doesn't give you the scores unless you pay for it, but it gives you all about your credit and all
the
about your
details.
liabilities,
Right.
right? And you should be monitoring your credit. You should be looking. I mean, I won't forget the second year I was in business, a good buddy from college calls. Imagine this. And he says,
Right.
hey, can you help me get pre-approved for a home? And, it's sensitive, right? Sensitive information. We get his application, we pull his credit, and his credit was terrible.
Uh-oh.
And I said to him, I go, bud, you got a mortgage in Texas? You got a car loan you haven't paid on and a mortgage? He's like, no, what are you talking about? It was a tough conversation to have,
Right.
but guess what? His identity was stolen and he didn't know it. So he had to spend about a year cleaning up his credit. So first things first, everyone should be taking a look and monitoring their credit. Second thing is people should not be afraid to meet with a mortgage consultant, especially when we are doing, at least at CrossCountry Mortgage, we're doing a soft credit pull.
Mhm.
There's not going to be any effect, and we're going to help you, right? We categorize our clients in certain buckets, right? And one of our categories is nurture. Nurture is the person that we take care of over time that's not ready to buy today, but might be ready in 6 or 12 months. We want to help everyone the best we can. And credit is that number one thing, to your point, that has to be reviewed.
And that's what that's why you're the best. That's why you're number
Thank
one
you.
at what you do, because you can nurture your client. You can say, hey, listen, your utilization of your credit card's a little high. Pay it on your credit cards. Your debt to income ratio is a little high. Let's correct that a little bit. Let's tweak a couple of things here and there, and then your score will rise and you'll get better rates, better terms.
We want you to be up here on the credit
Right.
the threshold, so your credit is the highest rating possible. Because remember, Todd, credit just doesn't affect mortgage, affects homeowners insurance. Or if they're applying with you, I'm assuming there's going to be an effect there as well, right?
Absolutely. Absolutely.
Are you seeing credit being affected on, are you seeing scores lower on newer business owners, or are people getting themselves in trouble with credit card debt? What are you seeing on your side?
I'm seeing a lot of entrepreneurs looking to start their own business, but don't understand the impact of credit. And they come in with like a 600 FICO score and they say, hey, I want $300,000. And it's just not possible because $300,000 unsecured, lenders in today's world are all looking for 700 or higher. So credit in my world is king. I'll see 40 applications, but only 10 of them are viable.
Credit's number one for you.
Yeah, yeah, it's right away, right out of the gate. If the score is way too low, it's a non-starter.
I always recommend, just one little quick tidbit,
Yeah.
if you have credit cards, you have a mortgage, set yourself up on auto payment.
Right,
Because let's face it, you might be busy with your girls. I might be traveling. You can miss a payment. We're not perfect,
Right.
but if you set yourself up on auto pay,
right,
you're going to be covered. If it's your credit card, at least the minimum will be paid, right?
right,
So,
right.
but pro tip.
Very good. All right, so let's talk about down payment. I remember being a first-time buyer and being 30 years old and looking at my first house, and it was like $250,000, and then I had the worry of just putting 10% down and then paying what's called PMI. I'm like, why do I have to pay for insurance? I don't understand. And then I was like, I am not paying insurance. I'm going to put together my 20% down payment. And then you're hearing in 2008, all kinds of mortgages failed because there was no down payment. There was no skin in the game. So maybe you can talk a little bit about no down payment, half the down payment with PMI, and then why you might want to just do the full down payment. And then how does that correlate into the house you're buying? Should you be buying in Fairfield at $800,000 when you may not have $160,000 to put down on an $800,000 house? So everything's relevant. So
So first things first, home buyers or people who are looking to buy homes eventually should never assume anything, right? They should really talk to us as the professionals because we'll guide them. A common misconception, though, is that people need to put 20% down. And the reality is you don't always need to put 20% down, even at $1 million. Okay. The conversation and the decision on down payment really comes down to what you can be approved for and then what you're comfortable with, right? So the misconception is you need 20% down. Now, you brought up PMI. PMI, private mortgage insurance, typically paid when you're not putting down 20%. Not always, but typically. Is PMI a terrible thing? No, it's not a terrible thing. It might have a bad connotation, or people might think, oh, I'm going to wait until I have 20% down. But let's take that scenario from before on that $500,000 house. If you wait till you have 20% down, and that might take another year, you might be paying $525 for that house you could have paid $500 for, right? So I'll give you a real live recent scenario. Gal came to us and she said, I've got $25,000 in the bank. My parents are going to give me a $50,000 gift. By the way, gifting is okay in 9.5 out of 10 programs that we have. So gifting is fine from a family member. And she said, I'm going to put the $50,000 down plus $10,000 out of my own cash. And then I'm going to use the remainder of my cash for closing costs, leaving herself with nothing.
Right.
Okay. I don't recommend having nothing in the bank after closing. At least have some retirement or something. Right. And when I looked at her credit profile, she had a credit card. It was like 20 some odd $1,000 at $440 a month.
Mm-hmm.
$440 a month. Todd, that could be a car payment, right? So I said, listen, how about we do this? We take the $70,000 that you have between your gift and your cash. We pay off the credit card, freeing up $440 a month. Then we take some money and use that for down payment. And then we take some money and use it for closing costs. And then we leave a little bit of money in the bank for cushion. And yes, Todd, she was going to have mortgage insurance, but she was freeing up over $400 on a credit card that, as you know, 24%, right? So you don't have to have 20%. You don't have to put 20% down. It really comes down to us as mortgage professionals being an advisor, right? We are not rate providers. We are advisors. We are mortgage advisors, just like you. You're not a rate provider. You're really a business advisor.
Right.
Consultant. So that's what we try to let consumers know is like, hey, we want to help you, right? We're not just here to sell you a mortgage and get you into an interest rate. We're here to help set you up for financial success.
Okay, great. So let's talk about a house being appraised and appraising out correctly. So let's say the seller just wants some crazy dollar for their house. But then when the house is inspected and appraised, it doesn't appraise or it appraises. So just kind of talk a little bit about home values and when you're buying and what you should look out for.
So first and foremost, every seller wants top dollar and then some, right? We're in a seller's market. We really haven't seen much of a shift away from that yet. First, I want to talk about appraisal versus home inspection because there's a little misconception there sometimes just for the people out there listening. A home inspection is to inspect the home to make sure the mechanicals and the house is properly functioning and there aren't any major issues, right? Mm-hmm. There's no valuation given to the home based upon a home inspection. A home appraisal is where the lender sends out a qualified, certified, insured third-party appraiser who goes out to value the home. On a purchase transaction, the appraiser is working off of a sales contract that they have in hand. So they have a sales contract in hand that says, Todd's buying this house for $500,000 and the appraiser is going out there and they're working on behalf of the consumer and on behalf of the lender to make sure the home appraises. Now, home values, I should say home purchase price numbers are exceeding the list price of homes. It's happening all the time. However, many of these homes are comping out and they are appraising. If the appraisal comes in low, we have to talk about a strategy to revise the financing to hopefully make that work. And in a lot of cases we can, or sometimes the buyer has to come out of pocket cash. Sometimes the seller has to come down. That's not happening a lot in a seller's market. Right. But yeah, the appraisal is an important piece. And that's part of the upfront consultation with the consumer based upon the home they're bidding on. But it's based on each home. It's not just a blanket consultation.
Yeah, so talk about that, and then we'll start to wrap it up. Talk about the pre-approval, not the pre-approval, but pre-qualification. So when your consumer comes to you and says, I need a mortgage, and the real estate agent wants to know before I start showing this buyer homes, they want to know, are they pre-qualified and pre-qualified for what? and then so they want to stay within their means. So
Mhm.
how do you get them to their means?
So first and foremost, the realtor has the key to the shiny object that everyone wants to get into, right?
Right.
But really, first, what consumers should do is they should come to my home buyer education class. Sorry, a little bit of a shameless plug there,
No,
but
please plug away.
we host that on the second Tuesday of every month just to get a little bit of education.
And where do we find
We
it?
actually do that on Zoom, and I'll give you the link.
Yeah.
So people can do it from their car listening in or from their work. But they really need to get educated first. Then they need to get pre-approved. We actually pre-approve, not pre-qualify. We can pre-qualify, but pre-approval is much, much stronger because we're actually collecting documentation and pulling their credit, soft credit pull,
Right.
whereas a pre-qualification is not necessarily that. And when we go through that pre-approval process, we're looking at the credit, the income, the assets. We're not looking at the property, obviously, because they don't have one in mind, but we're getting them ready, making sure their payments are within their budget, making sure they have the down payment, making sure they have the closing costs. Part of the conversation, though, is the appraisal and how do we set them up and what options do they have if the home doesn't appraise?
Mm-hmm.
A lot of them have options. Okay. Now, if someone's putting no money down, there are a few 0% down loans here, like state funded, grant type loans. And those work out really well. However, if the property doesn't appraise out, then obviously with no money down, that's going to be a tough road, right?
Over, yeah.
But we do have some programs with very little money down. But Todd, it all comes back to education and being set up correctly and really understanding what you're doing. If you go out on a Saturday and you go look at a house, there's probably going to be 5, 10, 15 people looking at that same house. And if every single one has a pre-approval and you don't, you're going to be in a very tough situation because you're not going to be able to bid efficiently, effectively, quickly, and know what your payments are if you haven't come talk to us. So as much as that shiny object is where you want to be, you got to start with us.
Great. All right. So, I want to bring that correlation back is the two of us, are consultants and we want to listen to our customers' wants, needs, and goals. And then we're going to guide them to the appropriate funding. And so I think today was a great conversation. This is a great podcast. I learned a lot, and I think, the word on the street is you do an excellent job in guiding your customers and also getting it done. The yes, is, so many times you hear consumers out there, they work with, say, a big bank and the deal falls apart because the funding never came through. And, with you, it's always a yes, and the deal is always done.
Yeah, I mean, listen, our
Great
team,
success.
Thank you. Our team has a never give up mentality, Todd.
Yeah.
And we're going to go to the end of the earth trying to figure out how to put your deal together if it makes sense for you and get it over the finish line and get you closed.
So Jay Tolisano, I want to thank you.
Thank you very much. I appreciate being on.
And again, CrossCountry Mortgage, LLC. You can find them on 46 Miller Street in Fairfield. And your phone number again?
203-913-4832. And you can find us on the web at yourhomeloanresource.com.
Thank you very much.
Thanks, Todd. Appreciate it.
Thank you, everyone, for joining our podcast today. It was very exciting having Jay Tolisano on talking about mortgages. And if you like this, please follow, like, and share, and I'll see you on the next one.